Okay, welcome to learning module number 7, where we're going to be looking at the different financial statements that organizations put out. And we're going to start with the statement of financial position, or the balance sheet. Okay, so the goal or the job, if you will, of this financial report is to show an organization's assets and liabilities on a particular day. And generally speaking, it is done at the end of the fiscal year. So the day that you're choosing is whatever the last day of your fiscal year is. At the top of the report, you're going to see the date that it was done, and December 31st, 2016, for example. Assets and liabilities, we've talked about them before, but let's just go over them one more time. Assets are things that the organization owns. So it could be property, it could be equipment, it could be cash, things that I have in my possession. Liabilities are things that I owe. So things that, bills that I have to pay, mortgages that I've taken out, loans, that sort of thing. So let's take a little closer look at assets. Assets are going to be presented at the top of a financial statement. So at the top of the balance sheet, it's going to be your assets. They're going to be presented in the order of liquidity. And generally speaking, they're divided into current assets and long-term assets. And if you remember, liquidity is the ease with which something can be converted to cash. And so we start with cash and we end with the thing that we have in our, that we own that is the least likely to convert into cash easily. So in terms of current assets, we're going to list our cash. We're going to list any marketable securities. So that's going to be stocks or bonds that we owe, something that we can sell relatively quickly and convert to cash. Accounts receivable and accounts payable. So the same type of idea there, that somebody owes us money. Accounts receivable might be, we had a facility rental and they had their wedding at our organization and they haven't paid us yet, so it is a receivable. They owe us money. Pledges receivable is going to be the same concept, except it's contributed revenue. So somebody makes a pledge and theoretically that pledge is going to come due, and we'll be able to convert that money into cash. Prepaid expenses, there are times when I have to pay in advance for something that I haven't used. A good example of that is insurance payments, right? Usually I pay my premium up front, but if something happened and I needed to, convert to cash, I could theoretically cancel my insurance premium and take that money out. And then inventories, certainly it can run the gamut from I've got things that I sell in my gift shop to, other things that I have in inventory. Maybe I have lion food or things that I use for program supplies that are relatively easy to convert to cash. Okay, next up we have long-term assets. So long-term assets are going to be things that it's increasingly getting harder for me to convert into cash. We're going to start with property and equipment. It's not to say that I can't convert it to cash, but generally speaking, it's a lot harder and it takes a lot longer to sell my property. In terms of equipment, this is going to be equipment that has a life of more than 1 year. And generally speaking, with equipment, I'm going to take the net equipment cost. So I'm going to take, whatever I own. Let's say I own a car, and I'm going to depreciate it over, 7 years or 6 years. And every year I'm going to take the equipment's value and I'm going to minus out the accumulated depreciation, and that's going to be my net equipment cost. So that's what's going to be appearing on my balance sheet. Investments. That's going to be not things that I can convert to cash. It's going to be investments that I hold, but that are restricted in some way. So my endowment that I can't touch. Maybe a board designated fund would go here, depending upon how onerous it is for me to be able to sell it. But certainly anything that is permanently restricted in my endowment where I can't touch the principal is going to appear as a long-term asset. Okay, so next up, let's look at the liabilities on my balance sheet. We're going to start again with current liabilities, but we're also going to have longer term liabilities. In this case, current liabilities are going to be things that are due within 1 year. So I'm going to start with accounts payable that are, that would reflect bills that I have, but for whatever reason I haven't paid them. Maybe there's a dispute, maybe there's something going on. That would be an accounts payable, money that I owe to somebody. Accrued salary expenses, that could be, we talked about vacation time. So somebody has accrued vacation time. Technically, they are owed it. And so that would be a liability that I would have to record on my balance sheet. Mortgage payable, again, if I have a building and I have a mortgage that's due, the idea there is, okay, you may say, why isn't that a long-term liability? Maybe a 30-year mortgage. We record in current liabilities what's due within 1 year. And the reason we do that is even if I decided to sell the property, chances are I'm going to have to still pay some of that mortgage liability for this year while it's up for sale, while the sale goes through, things like that. And so again, back to we want to be as conservative as possible. So the organization kind of assumes on its balance sheet that it's going to be responsible for those payments. Deferred revenue, there may be instances where I've received the revenue, but I haven't done the project yet. So I have revenue that, technically I have in my bank account. So, it's there, but I can't, it hasn't become official yet. And if I don't do the program, I have to give it back. So that would be a deferred revenue. Long-term liability. So these are going to be things that are due, that I've committed to in writing that are due after 1 year. That would be my longer term mortgage loan. It could be notes payable or bonds that I floated. Notes payable, the best thing to think about is, let's just say I have a line of credit and I've taken out $10,000. Well, that, if it's due over 5 years, the last 4 years are going to be a long-term liability.
Okay, and so the difference between our assets and our liabilities is called equity, or it's referred to as our net assets. Hopefully, if we're running a successful organization, our net assets are positive, so we have more assets overall than we have liabilities. And on the financial statement, it's going to be divided into two categories. So unrestricted net assets and restricted net assets. Unrestricted is, available to be spent by the organization at any time. And, we can spend it on the light bill, we can give ourselves raises, we can hopefully spend it on our mission. Restricted funds or restricted net assets are going to be the revenues that donors have restricted for some reason, so it has to be used for a certain purpose, or it's going to be money that is restricted for, a subsequent year, right? Maybe we haven't done the program yet, but we've already received the money, so it goes into a restricted fund. And then we eventually release it from restricted. So the presentation of the financial statement is going to show net assets in these two categories so that the person who's reading the financial statements can understand the breakdown between really what the organization has available to spend, which is unrestricted, and what they have maybe on the books, but they can't spend on their own, right? It's already money that's spoken for in some way. That's a restricted net asset. Okay, when you're ready, you can go on and we'll tackle the next statement.